Okay, we are streaming. Let's now check the live show to see that we are up and active. And we are live. Perfect. Episode
Cool.
number 7 of the TradingView show. And I'm thrilled to welcome Jim Huang, who I met on TradingView, and I love these stories because I spend a lot of time on TradingView, charts myself, but using the social network, and I could not ignore some of the ideas that Jim has been posting. I think one idea that we're going to go into a lot of detail on in this episode is about Silicon Valley Bank and managing risk. But before I talk anymore, let Jim introduce himself because I think it's worthwhile to hear about Jim's background, and we will talk about that in greater deal. But Jim, please take the mic and introduce yourself to our audience and all of our listeners.
Okay, thank you, Stephen, and hi everyone from the TradingView world. And I'm so thrilled to be able to join this program. And let me talk a little bit about my background. I had about 20 plus year in the industry. I started as an analyst with Reuters actually in America, Reuters America in St. Louis for about 3 years. I moved on to the Chicago Mercantile Exchange CME for about 10 years there. And then I started my business in China. And basically it's a commodity data business there, and generate data, compile data, and using the data to trade the market there. And then during COVID, I came back to the US. I'm now basically resided in central Illinois. I bought a farm here, which is about an hour and a half north from St. Louis, Missouri, and about 4 hours south from Chicago. So my experience with TradingView, I started using it in June last year. So I've been just track the record. I've been publishing 50 idea since then. So a little bit over one idea per week. And I'm very happy that my work get recognized by TradingView. And then out of the 50 idea I had, 30 of them get recommended in the editor's picks. And then 11 of them went on to the TradingView Digest weekly newsletter. So I'm very pleased to be here. And then Stephen, you want me to go straight talking about the Silicon Valley Bank, which I published about a month and a half ago.
Before we dive into Silicon Valley Bank, which is a huge topic and discussion for current markets, I think there's some chatter about Schwab now. There's PacWest, and then of course First Republic. But before we dive into that, you did say some things that I think we do have to ask you questions about, which is, so you own a farm? Is that correct?
Yes, 20-acre farm, but it's not tillable land, recreational. So I can hunt there. If I want, I can raise animal. I can go. There's no zoning requirement, so I can do whatever I could there. Just like I think the reason I bought it was exactly 3 years ago in the height of the COVID. I want to be able to find an isolated location away from anywhere I can live if the entire world get conquered by COVID. So that was the idea. I moved out of Chicago to come here.
That is so cool, I have to say. And what I have to ask you on that too is, have you noticed that living on a farm, does it help the way you analyze markets? Do you feel like maybe it's not it must change your perspective a little. Whereas I'm in Manhattan right now, I can hear the sirens going by. 1 in every 5 people I talk to wants to ask me about crypto or stocks. Whereas I imagine now that you're out in the country, you're kind of have like a fresher mindset potentially. But I don't know. But maybe that's not the case. I'd love to hear if living on a farm has changed your approach to markets.
Yes, I think basically it's very quiet, right? I hear animal. If I want to, I can stay away from human for weeks at end. Nobody will come to your place. So it's kind of like people are like kept to themselves around here. Everybody had gun. I had two guns too, so nobody will trespass you. I think the way is that nature help me calm me down. Right, I look at the market like Central Times 8:30 in the morning. Right, it was very busy. But for writing wise, I can step away from my computer. I can go outside, walk around my forest, which is kind of like a woody area. I had 8 acre out of the 20 is woody area. I live on kind of like 2 acre, mostly flat land, but the rest of the 90% of my property are woody area. So I can walk around there. So it's fresh air. You hear the bird and all the animals. So which is very nice. So you can really, particularly for writing, is very, very good.
So that would explain. So that last comment you said about writing is interesting because I have been reading the content that you publish on TradingView, and I've actually wondered, like, you write really thorough, well thought out pieces, and I think bringing back to my comment about being in Manhattan, it can be pretty hard to focus on a really thorough long form piece because of all the noises and distractions. And this explains a lot because your content is thorough, like the piece we have up on the screen, which is about Silicon Valley Bank, understanding and managing interest rate risks. Really, really topical discussion here, especially with some of the bank failures happening. But one more thing before we dive into it, because I have friends in Chicago, and I know you're in Illinois, but I see that you're wearing a Blackhawks shirt. I
Yes.
have to hear, are you a Blackhawks fan? Because my Chicago friends love the Blackhawks, and if they see, I'll send them this show just to say, meet a fellow Blackhawks fan.
I follow all the sport in Chicago, from football to baseball to hockey, and also like soccer, the men's soccer and even the women's soccer team. So I'm a fan of almost everything in Chicago. Yeah.
That's fantastic. That's so cool. I'll have to let my Chicago friends know, and ideally, if we can meet up at some point, if we ever make a
Great.
trip out there, if you're in Manhattan. So now let's dive in. Um, okay, I think the best place to start. You have the idea up on the screen, which people can read on your profile. Your deep dive into Silicon Valley Bank. I think the best place to start is to you walk us through um, this event. How did Silicon Valley Bank fail, and what were the mechanics of that? And also, I think it's important to comment on. It seems like what happened to Silicon Valley Bank is sort of just being copied and pasted onto all these other regional banks. The same thing's happening over and over again. So enlighten us. I'll let you take the mic away, and I'm all ears because I'm not as much of an expert on this as you are. So yeah, take the mic away.
Okay, so I think Silicon Valley Bank is the victim of the Fed rate hike, because that explode is a problem. Used to be not a big problem. Then all of a sudden, when the Fed raised interest rate 500 basis point in the last year. First, when you talk about Silicon Valley Bank, it's not like a huge bank, right? It's a regional bank. A lot of people probably never heard of them if you're not on the West Coast. Originally, it was a very successful business model. It's different than the other bank failure we're talking about, First Republic or the other signature bank. So this was actually a very successful and very instrumental to the tech basically revolution in the US. Basically the way is the Silicon Valley we know is all the venture capital, right? The private equity, they funded a lot of the tech startup, right? All the one that we had, the big one, whether it's from Microsoft to Facebook to Google, right? All of them, they were started in at that area. And for startup, they had a very high failure rate. So the way they do their business, they partner with the mostly the venture capital. So for as I mentioned, I started a business in China in 2012. So of course I couldn't get funded by bank because I'm the U.S. citizen. I went to China, start business. So no way they could lend money to me, right? But I started something that was very useful, particularly like commodity data that for people that trading, right? Trading the commodity market. So I get funded by a venture capital twice, right? So, but that's all I get. I get funded by them. But even I get funded millions of dollars by venture capital, I had no really banking relationship in China. No traditional bank will loan me money. Right? They didn't understand my business, right? So what made Silicon Valley Bank unique is they say, hey, a lot of the venture capital are very smart. They know how to recognize a startup company. They know how well they do, and they have a vision whether this business will do well in the future, particularly in terms of emerging new technology. So as a bank, any bank, they don't have the ability to do due diligence, right? How good the founder, right? How good the technology, what's the commercial potential in the future, right? So they set ideas that, hey, we don't have the expertise, but the venture capital had, and they do that by funding those startups. So they basically say, yeah, if you're a startup, you get funded by the venture capital, like one time, whether it's $1 million, $10 million, that means that you already get approved by the venture capital. You'll be are very successful. So we can rely on their expertise. And so basically, if you get funded at least once by venture capital, when you ask for working capital, any kind of loan, they will able to lend you money, right? And if they want to control their risk, they just, hey, we don't know anything about your business, and if we lend you money, then you can you need to give us like 5% of your equity. We want some share of your business, right? So one business could fail, but if you do enough of them, dozens of them, just like the venture capital, if one eventually went public, so they can make 100 times profit, right? So even the rest of them get wiped out. So that way, so when they service this community tech startup, so as long as for the last whatever in the 1990, 1890 now, so you had a lot of success rate, a lot of big company make it. So that way, so the risk is not very high, right? So that's their business model. So, and it's very important in the technology revolution since the 1980s. So they made a very important basically contribution to that. So that's their background. So now we fast forward to the last few years, right? So they had a really good at getting deposit. So for bank, particularly not one of the giant bank, the most difficult problem trying to attract people to deposit money in your bank, right? Whether it's a saving account, checking account, or CD, right? And there's a cost, right? The really related to the Fed fund rate. So what the government set the minimum rate. So your checking account, your saving account, interest-bearing account, you have to be normally will be a little bit above that, right? And the cost of attracting customer is normally pretty high for smaller firm. Is a lot higher than the bank. But they were so good because they align with the venture capital, align with the tech companies. So a lot of the startup firm that when they were small, they start up, they get funded by the venture capital. The venture capital had their money in the Silicon Valley Bank. And then when they lend money, is the money never left the bank. They just open a new account for the startup firm. The money move from one account to the other. And the venture capital like it because they can monitor the fund much better. It's still inside the same system. So you have small firms that originally has small money, $500,000, $1 million, but when they get big, particularly when they get to become like a public company IPO, so they still they had huge amount of money, right? A lot of them still maintain that relationship, so it's very easy for them to get deposit. So it is compared to the other smaller bank or regional bank. So they were good at that, but that come back to bite them, particularly since last year. So we had the economy deteriorating a little bit. That the main thing is that when the bank get money from the deposit, they need to lend it out. Say if the initially the Fed fund rate is 25 basis point, right? So you pay 25, a quarter of 1% to the deposit. So if you can put it away, normally it need to be like 1 or 2% above that. Then the so-called lending rate and the deposit rate, you had a spread about 2%. As a bank, you can make it, right? So why the economy are slowing down, but the Fed are raising rates. So all of a sudden, they had to pay a lot higher interest rate to people that bring money in. But with all those money, they don't know how to invest it. So they didn't have enough good, profitable, and also safe project they can lend the money out. So when you have $10 billion, $100 billion cash deposit at your bank, but you had to pay interest rate, it used to be 0.25%, now it's going to be 5%, right? So you need to make that money to work, and they couldn't. So at the beginning, they said, well, the short-term interest rate, the long-term, like the treasury bond, 30-year bond, right, 15-year bond, or the agency loan, which is the Freddie Mac, right, those kind of like the mortgage-backed security agency, U.S. agency, quasi government organization. So those pay more higher rate, right? So they were, hey, we are paying 2% out. So this guy pay us 3% or 4%. So we put our money in there. But the best thing is these are not liquid basically instrument. You put it in the agency bond. It's not like you can sell it right away without taking a loss on that. So the thing is that you had a liquidity issue. So people can come into the bank now, particularly with online tool, they can withdraw money right away, right? But when they withdraw enough money, the bank had to sell their asset to raise money to pay, right? So if you had $100 billion liability, anybody can come in to withdraw their money, right? And you put the deposit into this kind of illiquid long duration government bond. So if you want to sell it, and then you had a loss. And there's one thing with that, that's the liquidity. The other is the interest rate. Interest rate, what it means is if you had a long bond, its price is in negative correlation with the yield. So when the interest rate go up from 3% to 4%, now to 5%, 5 to 5.25%, right? So if your bond only basically, if you make it very simple, if you had a bond, you buy it at par. So let's say you buy 100 at par value, and you pay 2% interest rate. So it's 1% every 6 months, right? So when the interest rate go to 4%, but your bond already say, well, the next 20 years, I'm paying you 1% every 6 months, 2% a year. So $1 million, I can only pay you $10,000 every 6 months, right? So, and you cannot, because the Fed raised rate, you cannot say, I pay you 20,000. It's the fixed coupon. The only way that made your return similar to a new bond that now paying 4% is basically your bond price had to go down. So instead of invest $1 million, get 2% every year, and 10 years later I get $1 million, right? I can cut the price from $1 million to 900,000 to 800,000. So I still get that at 1% every 6 months. Right? That's had to be fixed. They already fixed once I issued a bond. But if I buy it with a lower price, I get invest in 900,000, but 10 years later, I get $1 million. The other bond is 1 million to 1 million, right? They get it from the interest rate. I get the from the price plus the interest rate payment. Then that will equate the return of my 2% coupon bond with your 4% coupon bond, right? So when the Fed raise interest rate high, so the only thing happen is these are long duration. You can get it, it's not due until 10 years later. You have to lower the price. So Silicon Valley hold this first is a liquid, you can sell it right away. The others are long duration. If you can sell it, but you can turn into the government and get money back, you just have to sell it in the open market and the market price crash. So, and the other thing is, after we learn about, I read that they are basically 10Q and 10K, they find out they really hedge their interest rate. So when the interest rate go up, so they lose money, but they have no hedge. So that's the reason they fell. So
Jim, I want to say really quick,
yeah,
it's remarkable that they did not have a hedge on technically what is, maybe it's not viewed as a trade, but it's definitely a trade because there's sort of like an opportunity cost with what they're doing with their funds. So it's remarkable that there was no hedge considering the size of it. But even before we go into that, I do want to just quickly comment to make sure I'm fully understanding it correctly, and everyone else is who's watching or listening. Essentially, they had, and this is what's happening to a lot of regional banks, they have a large portion of funds that have been invested into treasuries at a very low rate. And that low rate is now, now bonds have dropped in value and interest rates have gone up. And that low rate is not enough to cover their liabilities. Is that how we should think about it? And it's happening to this same exact process is happening to all of these regional banks as well. Do I have that correct?
yes, but it's not the interest rate, it's actually the value the market value of their asset. So they take in liability, right? I take in $1 million from you. That's the liability. I take in cash, but I'm not like have the cash sitting on my bank. I put it in an investment. You can think of that like these bonds are investment. So, but when you come in to say I want my $1 million back, I can give you the bond. I had to give you $1 million, right? But at this time, the $1 million investment into the bond now only worth 900,000. So I'm 100,000. So I owe you $1 million, but if I sell my asset, I can only get 900,000. If I want it to sell it right away, fire sale, I probably only get 800,000, right? So when they had to sell this illiquid, first it's already driven down by value. They had to raise money very quick, and then the fire sale caused them to lose more money. So their liability exceeded their asset in a great amount.
Wow. So I just kind of had the aha moment of it's customer funds essentially are put into treasury bonds, which are considered the absolute safest. The value of those treasury bonds drops, thus the funds that are owed to customers have also lost value, and now the banks no longer have the money to give it back to give the customers back
Yeah,
their exact value because the investment that they put the funds into has declined so much. Wow,
yeah.
and that's just
So
happening at each regional bank. Is that sort of your assessment? Is that First Republic as well
yes,
similar?
yeah. So if you look at this, right, just Silicon Valley, I guess it's up to March. So one is the treasury, the value, right, is the treasury price. So that's basically the market price. So you look at a year ago is 121. So if you had a par value of right? It's actually the market value 121. Why? Because you're getting interest. So 10 years later, you get a 100. But in the meantime, every 6 months, you get interest, right? So all this, you put it back to present value. 10 years later, the future value 100, and then plus every 6 months you get interest. So you bring it back to the present value is 121. That's about a year ago. So, and you see this is March. So it down from 121 at the worst case here, right? 111. So even you just measure that is close to 10% drop, right? So at the same time, you can see the Silicon Valley banks stock price kind of like going at the same time. So investors recognize their exposure to this treasury price.
Got it. And what's so interesting about that, now taking us back to the interest rate hedging aspect, is tell us about what it means to hedge against interest rates. Maybe an example of what that means, and then then I'd also be curious to know how come banks weren't hedging against interest rates. They just forgot about it. Poor risk management. What's your assessment there?
Uh, this chart here is actually very accurate because Silicon Valley, they don't think of them as a traditional bank. That's the problem. They think of them like they're supporting the technology sector. They think of them as a technical thing. It's not a traditional bank. So they do like, oh, they 1, 2, 3, 4, 5. They do 4 or 5 very well. They forget they had to do one, right? So they hire people that have no background in risk management as basically a risk management officer, maybe a political science or history major, people that manage their risk management. So they just ignore it. They are hired by people that realize that they're good at basically building relationship with people with money, good at getting their money in the door because they get perk and they get a lot of bonus from that, right? But they forget about how to invest them. They're not very good at investing those money, and they don't even know about the basic about the risk management of interest rate. So the thing with the bank is, right, if you just sit the money in the bank, it has no return. You taking money, you have liability, you had to make the money work, right? So that's the key thing about bank. You can take money from anywhere, but you have to generate more money with the deposit to be able to keep yourself alive, right? So that's the thing. And also, when you invest, sometimes you invest in those 10-year bond, but your floating rate or whatever, your CD maybe 6 months or 1 year, 2 year. So when the CD is still your money, you can't get the money out from your investment yet. So it's kind of like a asset liability management, AALM. So it's a mismatch. The duration is a mismatch. So maybe you had a lot of money, but you're not time to get the money out of the investment yet. But now your debt is still. So that these are the actually the elementary, the very basic of banking. So they saw they went so advanced in the game, but they forget about the basic. They get killed by the basic.
You know what I'll say to that too, as well, is well, something you said earlier on in our intro about Silicon Valley Bank. In that example, is they have played such an important role in innovation and funding a lot of tech companies. And what's equally interesting about that too is, and this is just sort of a tangent, just something to add to it, is the scale of the Silicon Valley bank run. I thought was pretty unique because all the tech investors knew each other. So as the word spread, it was like, it was like the first time where social networks almost caused a bank run because they could all share information so quickly. They all knew each other. They were all in the Bay Area or were connected to the Bay Area.
Yeah. So
It's so interesting that I don't know if we'll ever see a bank run like that again because it seemed to have happened in days. But I do find it interesting that I think a lot of people thought Silicon Valley Bank and what happened to it would be the sort of end of this, but it seems like there's a few more banks getting hit by it. And before our call, you told me an interesting stat, and I'll let you tell me it. It was along the lines of, even though there's been less bank failures so far since Silicon Valley Bank failed, the size and scope is larger than 2008. Is that what the stat was?
Yes. So in 2008, we had actually hundreds of banks fail, but only one big one is which is Washington Mutual is the biggest bank failure in U.S. history. But in the last 2 months, we had the second, the third, and the fourth. So the top five, three of them happened in the last 2 months, right? And then so that and Silicon Valley it wasn't even in the top five. So, but when you aggregate those banks, failure plus Credit Suisse, right? So the total basically market value of the failed bank the last 2 months already exceeded the basically market value of the hundreds bank failure in 2008.
That fact is so stunning to me. But I'll say this though, it's interesting is it doesn't feel like it though, right? Would you like so the size of the bank failures is larger today, but the market still seems to be acting quite well. But before we go down that aspect, I did see something interesting about that there was some commentary that people feel like regional banks are not being treated with the same sort of protections that the really large mega banks got in 2008. I don't know if you've had time to dive into that or think about that, but do you have any comments about it? Because I do find it interesting that the mega banks, the JP Morgans, the Bank of Americas, the Wells Fargos, they're sort of on this too big to fail pedestal. Government's always got their back, but these regional banks are just, pretty large. The regional banks are sort of dropping like there's dropping with not much support. I'm not sure if you've had a chance to analyze that or think about it, but any commentary about that sort of difference between the two?
Yes. So when you talk about 2008, we had most of the big bank get protected except for Lehman Brothers, right? So you had Goldman Sachs almost failed it, right? So the government inject whatever the top money, like 800 billion dollars, right? So they basically they protect the bank, they protect the shareholder. Nowadays, so when you look at this failure and the government rescue, they do not protect the bank itself. It protect the depositor, right? Protect the people that have money in the bank. So even it's over the $250,000 FDIC limit. But if you buy a share of Silicon Valley, you get wiped out. Nobody protect you. So it's kind of like it's treated not equal. So say you are buying regional bank stocks, so you're not being basic. You're reckless, right? But if you put money deposit in the bank, you're fine. So even you have $2 million there, so we protect 100% of that. So the rule is not really not very good. That not and then of course you have why Goldman Sachs gets say you can say Hank Paulson, Treasury Secretary from Goldman Sachs, right? So you had a lot of connection. The big bank they work the government, they work the Congress, but the regional bank they don't have that power. So they get kind of like okay, that's the standard bankruptcy procedure. We already out to protect the depositor, but while your people that buy your stock or buy the bond issued by the bank, then you're on your own.
There's so much good stuff to unpack there in the sense of I haven't thought of it that way, where 2008 was sort of a bailout of both the depositors and the shareholders, because the shareholders actually got to hold on to their shares. Sure, they got diluted, but they did just fine over the course of the last 10 to 12 years. Whereas
Yes.
now the regional banks it's protected depositors, but the shareholders are just getting wiped out. And, that is interesting to think about. I chuckle about it because you're right. The big banks have got there's networks of people, there's connections, and you're right. Hank Paulson was a former Goldman guy, and there he is, right there in the middle of the government during the 2008 financial crisis. But today, the regional banks don't have much representation. There's no one standing up in D.C. saying, you have to protect Silicon Valley Bank or First Republic.
Mhm.
They're. It's actually interesting. It's almost like they are too small to protect themselves, really. But do you
Yes.
think that it will that this interest rate hedging issue, where small regional banks just are not hedged well enough, do you think it will continue to ripple, or do you think we've seen sort of the peak of it?
Uh, I think we haven't seen the peak of it just because the Fed raised another 25 basis point, right? So it's not helping. So for a lot of bank, right, they if like we talk about when they buy bond, right, when they find their the balance sheet, they're being traded in two type of asset. One is they trading basically asset. The other is held to maturity, right? So say, hey, we buy this 30-year bond. We are meant to held them for 30 years. So the value fluctuate, but then, well, regardless, 30 years later, you get 100%, right? The US government bond, they won't default us, right? So they don't need to mark to market for that, right? So if I buy it, I hold it for a long time. So buy when you had a bank run or near bank run, you had too many depositors withdrawing money out of you. So you had to sell those assets before is maturity. That's the problem, right? Originally, the retail market, we don't mark to market, even if it's the only worth 80 cents or $1, but we still is a dollar because we said we are going to sell them after they mature, right? But now is that we need to sell them next month. So it only worth 80 cents. So that way, all in a sudden, disclose you had a huge hole. So you have billions of dollars less asset than your actual financial statement tell everybody. And it was legal to say you, but now you cannot hold those assets to maturity because you had to sell them to raise money to pay your depositor withdraw money, right? So those are a lot of those risks is not necessarily uncovered yet until they had a bank run. They sell all the other assets. They can raise enough money, then they will have to sell the held to maturity long-term bond asset. So that's the problem. So and if the Fed don't raise rate, so maybe we can get this problem go away. But now you raise more, another 25 basis point. So that means that your asset value will continue to drop. 5 basis point maybe not enough big but compared to 525 versus 5, so that's still quite a bit, like it's like a 5% compared to the initial rate. You're going up 5% more. So if it's a proportion, your asset value will drop another 5%, right? So they're already in trouble. So this will make it worse.
So I think one really interesting term you said, and it even brings me back to 2008. And I'm not trying to make too many 2008 comparisons because that was a pretty tough time for markets. But the term mark to market, I find, is something that always comes back up during big banking issues. And it's a term that you don't hear any other time, mark to market. But whenever there's a banking issue, I feel like there's a sudden spike in the use of that term. And I find that many people don't know what that means. Do you want to quickly just remind people what mark to market is and how that does impact banks in situations like this? And by the way, for the listeners, Jim is a CFA, which we will talk about soon. So he knows his stuff and went through quite the rigorous process to get that CFA title. But tell us about mark to market.
Okay, so probably instead of using bank, we use the futures market, probably will be easier. So let's say that when you trade a future contract, you had basically a leverage. So you put up a margin. So let's say the notional value of E-micro S&P 500 is basically 5 times the value. Now it's about like 4,100. So it times 5 is 20,000 $20,000, right? When you buy a futures contract, you're not putting up $21,000. You put up, let's say, $2,100. So that's only 10% of the full value we call notional value. So, but the thing is, when the index fluctuates, so your money will not be enough to cover it. If you buy it long, right? So it go down enough, it wipe out your $2,100 deposit, and could be more. So that way, we basically instead of waiting for you to get wiped out, so every day, actually twice a day in the future market CME, they mark to market based on the current rate and your rate. So you basically, when it go against you, the index lose 1%, you probably lose 10% because it's a 10-to-1 ratio, right? So if we go down, so in the middle of the day, end of the day, every day we mark to market and settle the difference. You make money, then your account will get credit for that amount. So instead of waiting till the end, and we find out you put in 2,100, but 5,000, right? It won't happen because we settle your debt every day, and you make money also every day. So incremental. So that's the mark to market in the future. That's why it's very safe. But if in the banking thing, so they do it every once in a while, particularly if it's the accounting ratio, they only do it every quarter. So during those 90 days, so the value could drop, particularly when they had loss, but they don't need to disclose until the end of the reporting period. So that's the risk, right? And particularly when we talk about the held to maturity, every quarter they say, well, this is, we're going to hold it for 10 years. So we always say it's 100, part value 100. We don't disclose the market value. So nobody know about it, right? So that's the book value. That mark to market is very important when you have to sell the asset right now. So that had to bring your whatever the book value, whatever in your balance sheet. You had artificial value in the balance sheet, but when you actually had to sell it, so what's the market value? How much you can get when you sell it today? So there's basically a huge gap.
So that is such an edge if you are willing to really do the research on that mark to market component, especially because if it's only mark to market every quarter, you can see where if a bank claims to have a certain number of assets or I don't know, liquidity to cover their liabilities, at one point in time, but the market could shift so fast and they don't have to market that shift daily or even weekly, where things could change pretty drastically then in a single quarter if they are ever forced to market what their assets might really be relative to their liabilities. Such an interesting position to be in as a bank. I don't know what the answer is. I know as a trader that makes my ears perk up because I say, holy cow, if there is a mark to market that's yet to be seen yet that could change sort of the financial picture of a bank. It sounds like it could happen in a day every quarter. You just think about what type of opportunities that opens up. And I'm sure there are funds, hedge funds, investment management firms that are looking into that very, very deeply. But that just highlights the term mark to market so well. And isn't it interesting? Wouldn't it be great if we as personal investors could mark to market our portfolio every quarter as we please? But nope, we have to do it daily. So it's pretty challenging.
Yes.
Do you have any opinions on that? Do you think that mark to market should be something that's done daily across the financial industry, no matter how large of an institution you are, or does it make sense to you that it's quarterly? I've never thought about it deeply personally, but curious to hear from a CFA.
Yes, I think that the way the accounting rule set up is no way nobody had that much power to audit your book on a weekly, even daily basis, right? So that's why they settle at quarterly. So every week, every day you submit some data, but it's not considered audit, right? You put in a system, but only get the big four, right? Your auditor to come in to take a look every 90 days. I imagine is the cost of getting a more frequent audit. That's huge. There is no way you get thousands of public firms if they had to be audited every week. So it's just the cost is unbearable, right? So they can't strike a balance if that had to endure that kind of cost. So how much it will cost their operating costs, right? Their stock price will go down too. So that's the thing that I think the regulation had to adapt to their change. So particularly with a lot of the AI and all the technology advance, it's not all by human, right? So they should be able to get their picture updated, because the market price is available. You can see it. We can see it on TradingView, right? Even those agency bond, some of them the more popular one, you can find it, right? So the thing is they should require some of the firm that at least in a system, government can basically look at their picture on a daily basis. If you say difficult, but I don't think it is. So when you look at the Treasury Department, right, they actually had a daily ledger. They show you daily and monthly that much money we had in the U.S. Treasury. You can actually go down to daily. So every day. So when I wrote an article earlier that about I predict that
Yeah, can you pull that article up? Actually, it's probably on your
yes,
profile. Yeah.
yes, no
And
problem.
I'll say that for anyone listening as well, or if it's just an audio form, we are looking at Jim's TradingView profile. We've had it up the whole conversation, as
Okay,
well as his idea about
okay,
Silicon Valley Bank. And one aspect, too, I want to say about the conversation we've had is the banking sector is very complex and it is not easy to understand. But I hope that people who have really hung on to this conversation or listening can really hear about all the intricacies of it, whether it's good, bad, or just maybe there's some opportunity or edge there for you to learn something new about how the sector really works. Because I think all the more complex components of the banking system are obviously more under the surface. We all hear about the glorified version of it, but it's very, very complicated when you dive in deep. And I hope that some of Jim's comments about that were enlightening. But yeah, take us through this idea and the U.S. debt situation. I actually saw on
okay.
that note that U.S. default risk is the highest it's been in quite some time. I just saw a chart of that.
Yes, yes, yeah. So if you look at, like, I published this the day before the tax day, like April 18, the US tax due day, right? So I predict that the government will bring in less money than the year before. That will make us like the huge national debt will be probably closer to default. And of course, you already heard that Treasury Secretary Janet Yellen already said that, confirmed my my suspicion. So when you really look at the text, it's a very interesting. Nobody know about that. Nobody really care about that. So where the government, the U.S. government, I'm talking about the government, get their money from. So 42% is our tax, the tax you and me pay every year, right? 42% of that. And then they, of course, when you get paid every 2 weeks, you get deducted, right? Those are the money that you get deducted every 2 weeks. Of course, your tax being an estimate tax is deducted from your paycheck. It's not like all the way till, but the April 18 is the day that you do the calculation. Whether you pay too much or don't pay enough. Pay too much, you ask for refund, you don't pay enough. But the other, you right, the social insurance, the social security, Medicare, Medicaid, all those tax, you pay every paycheck taking out of you, right? So, but the thing that most people don't know about that is not by most of us, I guess, at least including me. So it's really the top 1%, the people that foot most of that. So that's the thing that most people don't know, is the rich actually pay the most tax. It's not the rich, not the government keeps saying, I'm not those kind of rich, right? So, but I know from the data you analyze, they are the one that are paying most of the income tax. And they're not paying income tax from their paycheck. A lot of the wealthy people, they don't get a big paycheck, like Warren Buffett. he only charged his company $100,000 a year as a salary, nominal salary, right? So his wealth is from the capital gain, right? From his investment. Most of the rich people is from their investment. But we know what happened last year. Last year was the stock market down by more than 20%. So most people at the end of the year, they will write off the loss they had from the stock market, the S&P, the Nasdaq, right? The both, all of them are down like at least 20%. So when you, for example, if I make money on one stock, I lose money on the other, I will keep the winner last year at the end of the year, but I will sell the loser at the end of the year. That way, I can say, hey, I lose $1 million on this stock, so I can claim basically a tax loss, right? So that how what means that, because that's most of the, okay, this is the number, right? Top 1% income earner earn 22% of the income, but pay 42% of federal tax, and most of the tax come from and this 1%, they pay more than the bottom 90% combined. That's huge. 1% of people pay more tax than 90% of the population, right? So that's the rich actually pay their fair share, right? So that, and their tax is mostly come from their investment, their capital gain, right? When last year the entire stock market lost trillions of dollars, so they claim some loss. That will basically make them pay less tax this year. That's the problem, right? So with that, I already predicted the government will have less tax revenue coming. So that will make our basically that is still probably more urgent.
Jim,
Yes.
I quickly want to say on that note, what's interesting, two things were on my mind is one, I realized just how little attention this actually gets, which is just how much the stock market's performance helps the tax helps tax revenue. That is something that I think gets overlooked. It's a key component. If the market does better, tax revenue goes up. So that's really fascinating. And the second point on that is I don't know if I may not use this term correctly, but the tax loss harvesting strategy that's used in down markets. And before we do dive in too much more into the component of the Treasury, I am curious to hear your opinions on those types of tax loss harvesting strategies, because a lot of new traders and investors do watch this show or listen to it, and I feel like sometimes tax strategies don't get enough attention for new traders or investors. So what's your view on how about just walk us through the basics of taking a write-off on a stock to help that cover a gain? Take us through the basics.
Okay, so let's say I make it very simple. You start out the year last year, right? You start out the year, you had $100,000 to invest, and they say, hey, I'm going to put in $10,000 each in one stock. So I basically invest 10 stock each for $10,000. At the end of last year, then you look at before the end, of course, before the end of the year. So 5 of the stock that made money. So maybe from 10,000 to 15,000 or whatever made money, and then 5 of them lose money, right? So let's say 5 of them made 10%, 5 of them lose 10%. If you sell them all, of course, your winner cover the loser, so you don't have any investment gain. But do you want to do that, right? If you already had stock that go up, you probably want to hold that, right? So what if you just sell the winner? Of course, you own money. But what if you sell the loser? You can always buy them back. Remember, if you let's say you bought Tesla, right? Maybe it's $150 last year, and then it go down to 105 at the end of the year. You can sell it December 31st, and then January 2nd, right after the new year, you can buy it back at the current market value. You can still hold it, but if you sell it like from $150 to say $100, so you lose $50, right? So that will go against your income. So you can claim that loss. That will go against some of your tax liability. So that will actually bring your tax rate down, your tax bill, check to Uncle Sam down. So for this example, you have made some winner, you also have some loser. Then you can decide whether you want to hold on to that loser. If you do, then sell it at the end of the year and buy it back in January. Or say, hey, let's get rid of the loser and never buy back, right? So either way, it's a good idea to sell the loser by the end of the year. And those losses, even maybe you actually made money. Let's say the 5 stock you made 10%, the 5 stock you lose 5%. But if onto the 5 stock that made money, you don't pay tax because you haven't sold it yet, like unrealized gain. So you can make money, but at the same time, you claim a tax loss because you sell the stock that lose money. So see the difference, you're getting wealthier, but you're claiming a tax loss.
Absolutely, and it's still such an underrated strategy, and I don't know why it often goes ignored. Maybe because it's not the most fun thing to talk about, but if you're willing to dive into it and learn it, it can be so beneficial over the course of a trading or investing career. And it even kind of plays into the let your winners run, cut your losers strategy, so that you are taking advantage of those losses when you can, and perhaps letting those winners even compound more over time. So taking us
Correct.
back to your ideas as well. And one thing I did not want to lose sight of, and it's something that I think we needed to cover early on, but we've just been diving in so deep into these other aspects of markets, is your CFA and earning that title. And I always find it really impressive when people can make it through a test like that, because it takes several years of studying, right? 3 exams. Curious to hear why you pursued your CFA, and also curious to hear just how much studying you did. Because I've heard people say there is a lot of studying and a lot of textbooks that must be purchased.
So interesting, right? I told you I started as an analyst in St. Louis, with a state college degree. So, but when I joined the Chicago Mercantile Exchange, I said, well, it's not enough. Most people either get the University of Chicago or Northwestern degree, and they had all kind of different certification. So after some evaluation, I said, well, if I don't improve myself academically, I won't stand a chance at this cutting rate company. So at the time that I go through what kind of degree, I was a CPA, but I really don't like accounting that much and stuff like that. Then eventually I set my sight on the CFA. So I took it basically each of them one time. I passed level 1, and then the next year level 2, the third year level 3. So pretty much 3 on average is about 6 months, 6 month study. The way I did that is I was working I managed a small team, so I also had a family, so it's very difficult. So time management, how much time you can devote it to this. I couldn't devote a block of time every day to study. So the way I kind of like, they had 18 different areas they cover for each test. So I break them down with the study material. So I kind of said, okay, if I want to study basically 15 hour a week or 10 hour a week, if it's a 10 hour a week at the beginning, and then as the exam getting closer, it will be 15 hour a week. So I need to do like 1.5 hour to 2 hour a day, right? So I live in Chicago suburb. I had a 40-minute commuter train. So I figure, okay, if I study during the train, basically in the morning, in the evening, that's already almost 1.5 hour, an hour. So most of my task was when I taking the metro. I sit 40 minutes sitting in the metro to study. So I did most of them. I study there, and sometimes lunch hour I study for 30 minutes, and then only like weekend, Saturday, Sunday, I probably use half a day to study and maybe one evening. So that way I can manage my job, my family, and study at the same time. And also a lot of the preparatory courses are very useful. So for the level 1, I bought a material that at the time they call it a video CD. That's been so long, 15 years ago. So basically, you plug a VCD in your laptop, and then you basically just like us, like you on the side of the window, you had an instructor teaching you, and then the material will show up on the majority of the script, right? So I did that a lot of time when I drive. I basically put it on the passenger side, the laptop, and had it run. So when I drive, I listen to it, right? So and then you listen to it enough time. So that's a part of the. I try to put my time, break it down, and I actually had a spreadsheet makeup, and I basically I used 15 minutes as a quarter hour was the basic unit. If I started 15 minutes, I log it down. So every week, so I analyze how much I study in what area, right? And then I do some mock exam and see how I did. So that way is that how much time you spend and what's your test result. So whether you do well or not, okay, you don't have enough time or you didn't do well, that means that you have to spend more time on that. So we kind of like really specifically concentrated strategy, concentrate on your weaknesses. So but persistent, right? Yeah, about 6 months or so.
So I can so relate to your commuter study approach strategy, and I loved hearing that. I have just recently lengthened my commute because I moved, you could say, to more of a suburban like area. And I have learned to cherish that commute so much. And it is the sort of that one time where you're sitting there, you have a really defined set of time, and you know it's all for you too, right? There's nothing that's really going to distract you because you're just going from point A to point B. You know, you could stand up and stretch if you wanted to, or surf your phone, but there's probably better ways to use your time. And I've been looking for ways to maximize my time on my commute to do something enjoyable or a hobby or an interest. And so to hear that you used it to pass an exam, I think is actually for me, you know, really, really helpful to hear and interesting to hear. Also, time management when you're going through these type of tests. Especially as you age and you do start a family. I recently started a family. You realize
For you.
how like important that skill is. When you're young, you have so much time on your hands, and I realize now that time management has really never been more important than it is right now in my life, and I'm trying to master some of those strategies. So, any other thing that you would add to your time management, and do you find that it helps with your trading? So, if you're planning a trade or researching a trade, are there certain ways where you apply what you learned from all the time you spent studying for the CFA to that strategy or to that trade? And by the way, I see on the idea in front of us, the text on the screen, you have a section that says short-term trading strategies. So we'll have to cover some trading strategies in this chat. But before we get there, tell me about maybe your process for trading and time management of your trading strategies.
So for me, I think only when the technical aspect and the fundamental aspect align, that I consider a good trading strategy. So I won't just go into take a look at the chart and say, okay, is a good chart, and I trade. I don't, and I didn't understand why it behaved the way that it did, right? So what I did, particularly on TradingView, right, what I try to be, I know a lot of people are very good chart reader, right? They are very good at that. So I bring in some more like on the fundamental analysis. So for me, is that why I think the stock market like will see. Like for example, so at this point, most people at the time were saying is going to go up, right? But it actually went down, right? Went down, particularly almost the point. So if you really look at the technical aspect, that could be seen, oh, it might be going up, but I assume it's going to go down, right? So that's is one of the major aspect, and I see that if we had less than a month to resolve this problem, right? We actually already exceeded the limit. Is I think was 31.4 was the limit. Is actually already 31.7, which is 2 months ago. So it's already exceeded their problem. They had to like pay some bill and delay the other bill. That kind of strategy to keep the line off, right? I think when you trade, of course, you need to learn a lot. I think TradingView is a very good play to learn. And then, of course, the other like the YouTube, I've been taking a lot of things from YouTube, like particularly I wasn't from IT background. So the last few years, I've been taking some programming like Python or SQL, those things. So I can learn it from YouTube. There are a lot of free material there as well. So of course, the idea, trading idea from TradingView will be very good, but you also need to learn some fundamental skill, whether it will be chart reading, right? So whether it's a programming or fundamental. So before you risk your own money in the market, I think that's I would say would be a good idea to pick up some skill. Not necessarily just listen to me that without really understanding for my strategy. What if you lose money? So who can you blame, right? So you need to be able to, okay, I give you some idea, you can incorporate it in your own strategy, right? So but it's not like that you should follow something someone that you had no idea what they're talking about, just blindly follow their advice. So that's not good, not even for me, right? So don't do that. So but for people that trade, then they need to learn. I think learn as much as possible. That will be a good thing, regardless of what you trade.
I love the aspect of combining technicals with fundamentals. It's something that I feel like could really get more almost marketing to it, or more. I wish there was more awareness on that subject because, well, first of all, I've found that fundamental investors and technical investors sometimes find themselves in opposing camps. It's almost like they kind of battle each other and disagree with each other when actually there's so much potential for more of a combination of the two. And one example I often think of, and it's a support level in technical analysis where
Yes.
you mark a support level and you say like, okay, this looks like an area where there's buyers or it's something I could watch. But I often think to myself, but there really only should be buyers if there's a fundamental case that buying it makes sense. Like I'll get there's value there for me to invest in. If there's no value, if there's no fundamental case, a support level it just doesn't really make sense to me. And that aspect of combining the two, I think, would really help a lot of people because then they would also zoom back and say, what is the actual business case of owning this? Like, what is the value here? How will it generate returns for me based on its profitability or its usage or the soundness of the project if it's a cryptocurrency, for example. So I love that aspect. I wish more people would talk about that and combine them. For our conversation and especially this US debt idea, I was wondering how do you approach something this big and this macro as a trade? Because I see the fundamental case, right? The fundamental case is you're going into the finances and you're breaking out the finances and you're saying, well, this looks like a precarious situation or it looks like a sound situation. But then how do you place the trade? Are you someone who looks at the S&P 500 as your trading vehicle? Are you trading bonds, futures? Curious to know what you're watching for the majority of your trades.
Okay, so that's a good point. I'm more like a event-driven strategy person. So I trade a lot of different things, but I analyze an event is something that's going to break out, and then I will then find what will be the best instrument to basically take advantage of that. So sometimes it's not very apparent. For example, that it go back to 2018 and 19. At the time, the big event was the U.S.-China trade war, like the Trump and Xi, right? So at the time was really we're raising a lot of tariff, right? So if you really look at which get raised tariff, and sometimes let's trade that. For example, one of the biggest product that U.S. export outside, beside the airplane and stuff like that, but is the soybean. Soybean is the biggest agricultural commodity that U.S. export. And then, like say, China raised 25% tariff on the U.S. Tariff. If you they from Brazil, they don't, you don't need to pay that. But if you buy it from US, you pay 25%, right? So things like that. So originally, said, well, let's trade that. If you raise 25%, then the end product, like the soybean go up 25%, but soybean, what do you for? You crush the soybean to soybean meal, which is used to feed animal, and soybean oil used for cooking, right? So if the soybean go up by 25% because the tariff, and then the soybean meal and soybean oil would go up, right? So then, of course, when that go up, so if you buy pork, their feed go up, the cost of the raising go up, then the pork price would go up too, right? So since that's the original train of thought, but when I tried to apply to market, it didn't work very well. Then I finally find one way to say what's the biggest impact is when Trump, particularly at the time he used Twitter, right? When he said, "Oh, I'm going to raise 25% on $100 billion Chinese goods." When he announced that, that make a huge ripple to the market, right? Or if they want to talk to each other, then they say China make an announcement, say, "Oh, Vice Premier New Her pick up the phone and talk to the U.S. Treasury Secretary." So that's a signal for, okay, these two are backing down, right? So you can see that one when every time when Trump basically putting a twist, they say, "I'm going to do this, I'm going to do that." So is the risk go up, right? And when they pick up the phone, they say, "Oh, we arrange a meeting in Washington D.C. or in New York or in China," then the risk go down. Then I look at the entire across that is gold price that affect the most. Gold is a measure of risk. When the risk go up, the gold price jump, go up, sometimes limit up. And then when the situation calm down, so the gold price go down. So it's interesting. It's the event driven. When they announce it, it will jump like a 3-4% huge jump. And or when they announce the other way, it will jump down. So basically, once I watch that, I kind of like anticipate what would be the next move, right? So I basically buy gold option, call option, if I expect them to escalate the tension. So it's interesting like that, right? So even gold was never on the tariff rate. Nobody raised the tariff on gold, but eventually gold is the best. I mean, in my experience, the 2018 and 19 was the best trading instrument. They measure the risk when they go back and forth several rounds, 5 rounds, and it's go back and forth raising the tariff. Each time, gold price jump up, and then sometimes they raise it, and then okay, let's talk, and then it go back down. It's kind of like repetitive. So you anticipate, then everything look good. Then okay, so next week Trump going to twist and then spoil the party. So that way I can put in a call option. So it's interesting that sometimes that you analyze the event rather than analyze a trading instrument. So you analyze an event something, and then you say, "How what would work well with that?" So if another example is the Russian-Ukraine war, right? So when the war started in February last year, right? So what get affected the most actually is winter wheat. The two country export market combined about 25% of the wheat were collectively exported by Russian and the Ukrainian. So when they start a war, so the wheat cannot be export. So the market jumped huge, went up like 60%. The price. So that's interesting, right? When the two countries fighting, so what get affected the most? And then I chose also in TradingView, one of my pieces I wrote about that.
So I'll say that. Well, could you open up the soybean oil idea? Because the stats and facts about soybeans that I read in that article that you published um, blew my mind. Actually, I did not know the sheer size and scope of the soybean market. Before we talk about that, though, I do want to say being an event-driven trader is super interesting, and it's not something that people really hone in on. Oftentimes what we hear about is swing traders or day traders and options traders, but being an event driven trader, so looking for these events, especially on the macro level, these huge market moving events, and then trying to trade these events, I think is not only complex but very very captivating, and it kind of requires you being really plugged into the news, I'd imagine, right? Or understanding how certain news events are going to impact underlying pricing structures for certain assets. How do you keep up with that? And are you using a watch list, or is it a news feed, or are you sort of do you spend a lot of your day thinking about what the if then outcomes could be of various events? Talk to us about how you're managing that information at such a macro level.
Uh, First, okay, this the one that I talk about in the uh, so oh, that's the U.S. China trade war, but that's probably I rather to okay. Like this, the one that I just mentioned about the U.S. China trade war. That's the why they were doing the trade war, and that's the gold price. So tariff, and then they talk, raise tariff, and then they talk, raise tariff and talk, raise tariff and talk. See, that's the I mean, it's hard to say that it's just like I find the pattern. They keep like it's not all the way up five. They find a little bit and then they will back down. Find a little bit will back down. I found that pattern. So basically, I found a pattern, and then I look at different kind of commodity, right? Say what would be really affected by that. So in terms of trading, right? Of course, you learn about really you watch CNBC or something, you pretty much cover almost everything, right? So the financial news media, they will talk about a lot of things that will affect financial market, political and otherwise. So and then you probably would want to stick with something that you understand based on your experience. Of course, I grew up in China. I moved to the US in 1992. Years ago, but at least in my childhood, so I understood this more, right? If you never been to China, you did not understand. You can really think through the thinking of the Chinese leader, why they did that, why they say that, right? So it probably wouldn't be good for you. And like the Russian-Ukraine war, I've been to Ukraine a few times, so I kind of like at least I had some connection that I think I would understand that. So I think that would be good. Just like Warren Buffett, right? You only invest in something that you know. Sometimes that people do the technical analysis and trade, they don't even know what the instrument is. They're trading based on because the chart's good. So that would be. So I would try to be investing in something that I have some personal experience I can relate it to. That way, I have some way to understand the thing. So it could be different, everybody. So it don't have to be the same. So, but if they say, do you understand Chinese or do you understand Ukrainian? Something you had, so that's something I can invest. So but if it's something that I had no idea, so I probably wouldn't be able to analyze that. So in the market, you're not trading an instrument. You are really trading against a trader, right? It's most of the time it's a zero sum game, and sometimes it's less than zero sum because the exchange and the broker take a chunk of the money too. So so you need to find yourself have a so-called competitive edge against the other. So that's why I don't trade saying that investment bank trade, because I no way, I don't have the money, don't have the skill set, anything that trade against them, right? So so you need to be able to find something that they don't know better than you do. That way you had an edge.
I have to say that that once again even ties together the aspect of fundamental investing with technical investing, because your comment, even using the Buffett quote about investing or trading what you know, is a fundamental case, because you're saying, I know this, I have an understanding of it at a fundamental level, what it is, why it, you know, why it why it exists in the first place, or what the business case is in the first place, and you're taking that fundamental information and then, using a maybe some technicals or a trading strategy on top of it. So I love that aspect, and I think it's a reminder that can be said over and over again, which is just trade or invest in what you know. And I would say equally interesting on that point too is, I think it's easier to manage a position, whether it's, choppy or downward or goes against you for a bit, if you still know the underlying fundamental case, because you can actually feel a little more confident, like, wait, I actually know this. So sure, there's a slight drawdown, but I know what it is. So it just can help you a little bit more. And yeah, it's something that could be shared actually more often, which is trade or invest in what you know. And hearing that background, that you grew up in China, so you could relate more to what was going on there, I think is a really good example of that. And yeah, just to me, fascinating trading what you know. This special report about crude oil futures, I love this post that you wrote for the people who are not able to view the screen if they're just listening in audio. This is a post that Jim wrote about crude oil futures and the history of the NYMEX. And I know we're sort of nearing the end of our conversation here, Jim, but we should talk about this quick, because it is an inspiring message to end on. And I'll tell you why I think it's inspiring. Then I'd love to hear you tell us about this post. Is I loved reading about how young the NYMEX founders and board members and chairmen were. I'm in my 30s, and reading that these gentlemen were in their 30s was super motivating to me. Like, wow, look at these guys in their 30s creating this massive exchange. Everyone thinks of like the older guy. That's kind of market history behind markets. Whereas in this case, the NYMEX, a bunch of 30-year-olds. I mean, so cool. And tell us what the NYMEX is, and tell us about this idea that you wrote about and have up on the screen now.
Okay, so it's very interesting. Actually, when I did this before, was I had a consulting assignment on future, which is at the Chinese exchange want to launch a potato future, which they're actually the biggest potato producer. So one of the things they want to understand, the 1970 uh, so-called NIMAC made potato, but the biggest default in future history, 1976. So that's when I didn't know NIMAC trade potato. So we know about they trade the crude oil, natural gas. So since when they trade potato, right? So I dig into that. So and found out all the way from basically from the 19th century all the way to 1980, they were mostly agricultural commodity exchange, the New York Mercantile Exchange, mostly agricultural commodity exchange. And it was they had a big bust and get penalized by the regulator. The CFTC was founded in 1975. So they penalized them. They said, well, you did so bad, or you that was the biggest future default in history. And then after that, then they had to find a new way to basically go. So so the biggest contract like at the time, potato future get delisted from the exchange. So when it about your biggest money maker get become illegal, right? So you had to start somewhere, and for them was a good opportunity was that because they get penalized and also had a lot of lawsuits, so the entire board director resign, right? So and then they elect a new board. That's very interesting. You probably don't know that before this exchange now public company, before they were kind of like run non-profit mutual organization. So they collectively owned by member. The one that on the trading floor, those are the owner, part owner. When you had a seat, right? Let's say at the time maybe it cost $50,000 to buy a seat for the privilege to trade on the exchange, right? So then you own a small share of the exchange. So the entire at the time was like 800 member own collectively own NIMAC, and then all the board director are come from them. You don't have corporate, the professional board director or outsider, all come from the board member. So the last board, so did poorly, so everybody out. So they elected a new board. They're interesting. So in a kind of like the Democratic election, so who had the biggest crowd in that community will get support, right? So this Michael Mark, his father was a very basically is you consider like a leader on the trading floor, very influential. So and this he's interesting, right? If you have you ever been to a exchange trading floor like the New York Stock Exchange, Chicago Mercantile Exchange?
So I've been to the New York Stock Exchange, but I have a feeling you've probably seen I saw the exchange in the last 5 years, and I think the thing that surprised me, and I think would surprise a lot of people, is actually how quiet it is now. I think they were filming CNBC there, but besides that, there's 30 people walking around and looking at monitors, and that was kind of it. But I think the vision of people on the exchange is really has really disappeared. It's all gone so digital.
Yeah, so if you really want to know about that, you can watch. I recommend the movie 1983 movie Trading Places, Eddie Murphy and Dan Aykroyd, Jamie Lee Curtis. So it's basically about surrounding the idea trading pork belly future, frozen concentrated orange juice. So it's a comedy, but it explains a lot of things. So at its height, at the New York Mercantile Exchange, they has like $4,000. No, so 4,000 people on the trading floor. You can think about it. It had two actually upper trading floor and a lower trading floor. Each one can hold up to 2,000 people. That's how much people there, right? So it's huge. But we come to that before electronic trading, all the trade were open outcry, people yelling and making hand signal, So this guy was there are several different people, type of people on the trading floor. One are the one they're wearing a bag, they are trader, right? They had a symbol of the trader symbol. So when you do a trade, everybody write down your position, your trade. That's the symbol too that you submit it, get clear. So this guy was started as a runner because his family owned a membership, a trading firm there. So he worked for his dad. So when he was in high school, so he worked as a runner. We call yellow jacket. People they were taking order from here to there, and also maybe buying a hamburger for the trader, right? So they do all kind of like supportive work, running around, collectively called trader, wearing yellow jacket. The trader probably wearing blue or red or green jacket. So he started
Can
as
I say?
a
Can I say
runner.
really quick that that is actually something that I think is probably missed because it's so cool. Like the jacket you wore on the floor was what you were. The yellow jacket meant you were running around doing tasks for traders. The blue jacket meant you
Yes,
were a trader. The green jacket meant it's kind of a
yes,
bummer that that doesn't exist anymore because that would be
exactly.
really cool to. I mean, I would love a jacket, I have to say, but yeah,
So so
keep going.
yeah. So yeah, I know we pressed with time, so I very quickly. So he started as a right, but the big thing with him was he went off to study at Stanford University. So he got a good college degree. Then after that, he came and then he bought a membership. So he, instead of going to work for Wall Street, Goldman Sachs, so he went back to the New York Mercantile Exchange, trading potato and trading other contract. So he's a member. So he was like 25 years old, but he owned his own seat. So when this entire board got wiped out because the 1970 episode, so get election. So and his dad pushed him out to for election on the board. So he get elected as a vice chairman. So even he's only 26 years old, but he's representing his dad, who's influential member. So he get the vote. So he became the vice chairman of the board at age 26. And then a year later, the chairman at the time had a stroke, paralyzed. So he's kind of like, okay, instead of had another election, just had him as acting chairman and eventually become chairman of the New York Mercantile Exchange at 27 years old. So that's why we call them accidental chairman. Before was okay, you are just like a vice chairman, but it's kind of like it's just for recognition of your father's role, right? Put it on you're just a backup guy. But all of a sudden he become the chairman at 27 years old. So interesting, and the way he can manage those trades is he's the only one had a prestigious college degree, so he's open-minded, right? And he's been on the trading floor even that young. He already at least had 5 year experience on the trading floor. So he's get accepted by the membership, his family, and he himself. He had experience, and then he's open-minded. He understand the world. So he's the one that basically hired the guy John Tritt as the president. That because he was the Carter administration energy basically energy advisor. So they say, how we can do computer, potato, how about we go into the energy sector? So hire someone that as a government energy advisor on board. So he helped him to get on board. So with that, so he basically launched the new direction. So and also they both went to Stanford, so they were college alum. So that helped to that get the bond. So this guy also in his early 30, and the only reason he accepted this job is Carter did not get reelected, right? So one-term president. So he's just like get out of. The next one is Reagan administration, right? So he's a Democrat, so he can stay in Washington anymore. That's why he probably will still had his career in Washington in the government, but because the re-election failure of Carter, so he went off. And then so combined with those that made that happen, that's a very interesting.
I think that that story is fascinating, especially for futures traders or anyone trading commodities. The NYMEX, the New York Mercantile Exchange, handling, I mean, just huge amounts of trading volume around the world's most important commodities. And I personally love the story because of the age of the people who really helped get it started and spark its growth. So for any young people listening who are interested in markets and are trading and investing, I think this is really an interesting lesson, and you should head to Jim's TradingView profile and read this idea because there's still a lot of opportunity in markets, and it doesn't always have to be trading. You could help an exchange or various products or research tools, no matter what your age is. So I think it's a really good lesson, and it's well worth a read. This historical post about the New York Mercantile Exchange and when its growth really got sparked and started, and the people behind it. And on that note, Jim, I know we've gone well over an hour now. I do want to conclude the show and say thank you for joining. And we covered so many topics. We did Silicon Valley Bank. We did the regional banks, interest rate risk. We talked about the NYMEX here at the end, your journey through the CFA, and the ideas
Event
on
driven.
your TradingView profile, exactly, including being an event-driven trader. So for anyone listening, I think there was a ton of information here and a lot to learn from the interview. So thanks a lot, Jim. And I guess for me, I would just end it with telling people to make sure they head to your profile and read all the ideas that you're publishing, because these are in depth and there's a lot to learn there. So be sure to follow him on TradingView and to read his ideas. Do you have any final words you'd want to end with?
No, I'm pretty exciting that in the past I was just like minding myself, writing stuff. I really communicate with people by their making comment and respond in a very quiet way. So this is the first time really interaction using the video streaming. So I'm pretty excited.
Fantastic. And we hope to keep the TradingView live streams going. And Jim, if you ever try live streaming, just let me know. I can help you get started, and it's pretty easy. You could do chart live streams. You could walk through your ideas. You could do all sorts of cool shows through this tool. So thanks a lot for joining us. I'm going to end the stream,
Okay.
and to everyone listening, thank you so much, and we'll see you at the next show.